Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, March 22nd, 4:13 p.m. Eastern Time, coming to you from the financial capital of the South, St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we've upgraded from cautious uptrend to uptrend as we reclaimed some key moving averages on the major indexes and continue to see strength in leading stocks and frankly in this rally off the bottom. So as you can see over here on the trend gauge, we earlier this week, actually late last week, upgraded market leaders to neutral, arrow pointing toward bullish. We continue to see good action there. Short term, we upgraded our short-term indicator, which monitors the 5 leading indexes that we track in each of these videos versus their 21-day moving average. We upgraded that to bullish last week. Today, upgrading medium term from down to neutral. You'll see why momentarily. Long term, still on bearish or downtrend, but we want to see how this week closes before we move this off to upgrade it at a minimum to neutral. And if things continue the way they have been, we may end up at bullish if we close the week with all of the indexes above the 200. Not very likely for small caps, however. So what just happened today? Well, you can probably surmise if you see the green font, the green colored font being used in the agenda here, that it was another good day. Key happening today, the S&p 500 reclaiming the 200-day moving average, the nasdaq 100 reclaiming the 50-day moving average. All green here, G6 again leading up 1.7%. S&p 500 gapped up 1/3% at the open. Trended sideways to up the entire day with a nice close at 1.13%. NASDAQ 100 up nearly 2%. Dow up 0.74%. Mid-caps 0.64%. Russell up 1.1%. Global 60/40 stock and bond up 0.6%. GROTECTION up 0.26% on the day. We lagged because our cyclical type holdings in oils, fertilizers, lagged a little bit on the day, and our leader NVIDIA gave back a little bit of its recent gains. So let's go to the tail of the tape and the charts. But first, let's go to the team here at Revere. Trend followers is what we are. Participating in uptrends when the market's going higher, dial it back a little bit when we're going sideways, get defensive when the market is in a downtrend. That's what we saw for most of 2022. Things changed last Tuesday, and then especially Wednesday after the Fed raised rates and Jay Powell had his press conference, which he tried to dial back a little bit yesterday, and all the market did was pull back slightly for about half a day and accelerate more of the upside today. So market liking what it's hearing. Whether or not those actual results, if the economy continues to stay strong and we can continue to raise rates, but more importantly, we need to see inflation moderate. We won't guess what the result is. We'll take our cues, as always, from the market. And if you want more info about this approach, you can email any of us, Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. Let's get to the tail of the tape and the indexes. Blow this up a little bit here. What a difference 5-6 days can make in the market, where things looking pretty bleak, just as last Tuesday, 314, actually that was last Monday, 314, testing the bottom of the range. Next day, day before the Fed, we were very lightly in the market at this time. And then let's bring up a 30-minute chart here, and you'll be able to see the big change that happened here on the 16th. So dragging lower into Jay Powell. This probably show better in a 15-minute chart. Yeah, he comes out the statement comes out and we immediately sell off, and it looks like we're heading to test the prior lows. Very big turnaround starting at 230, 245 on last Wednesday, and we've really been off to the races since then. As you can see, we closed at the highs of the day Wednesday. That was Fed day. Trend up day on Thursday, trend up day on Friday. Now, this is where Powell tried to talk a little bit tough yesterday. Didn't matter. Little brief pullback, closed down on the day, but it was really a constructive day for leadership type stocks. And then today, a little bit of a gap up to new highs, go sideways to up into the close. And this has just really been good news for the market. Now, critically, we regained last Friday, we regained the 50-day moving average. That's the red line, after getting back above it on Powell Day on the 16th. So first the 21, that's our short-term indicator. So two closes above there. That's when we upgraded on the 17th, St. Patrick's Day. How fitting. Back above the green line on St. Patrick's Day. Back above the 50-day Friday, and two closes above on Monday. So two closes above the 50 now. That's the red line, which is still declining, by the way. We need this to hook back up. But we ran smack dab into the 200-day moving average, and it acted as resistance for 2 days. However, today, break through it, no problem. Didn't even really back test it after we did break above it. So just strength. It gets difficult to continue to put money into the market after you're up 5 out of 6 days. And that's why we go on 3 time frames: short term, medium term, and long term. And really, first, when we want to get back above this short term is when we want to start getting some money back to work. But we've gone over the last week from an exposure of 0.14 to today closing at 1.22. All for the most part with low risk entries, and we've made enough progress now off the bottom that if this rally should fail, we should be stopped out and really not have lost anything from where we started from, where we came off the bottom. And that's called using your progress to finance further forays into the market. So as the ideas that we start off with start working, we add more into either those ideas or to new, fresh ideas. One idea that didn't work, I'll talk about momentarily. So let's go to the tail of the tape. You can see uptrend there. We continue to have the same headwinds. Put call at a 0.96. Now here's key. The VIX under 24-ish, when it's coming down, you want to have at least, if the market is cooperating, and it has been, this is a good time to get at least the same allocation to the market as the S&P 500, which is 1.0. I mentioned we're up to 1.22 in our adjusted exposure right now, but the VIX has been cooperating. It's below the 50-day moving average after being above it for a while. So the VIX is helping us out. The fear and greed continues to climb, still at mild fear with a value of 43. So here's our bull case. This initiated going from bearish to bullish on 316 when we had the follow-through day. And our bull case was to initiate a rally and reclaim the key moving averages. We've done that now on the S&P 500 as we're back above the 25, the 50, and the 200 day. What would change our minds? Failure of the rally and break back below these key moving averages that we've reclaimed now, especially we want to starting with any pullback, we want to hold the long-term 200-day moving average after we had 6 weeks of closes. 6 weekly closes below the 200-day. That's when risk is most significant in the market. But back above it gives you a feeling of comfort, as big losses in the market normally only happen. Not normally, they only happen. And I'm talking about when you're going to have bear markets. First thing that happens on the way to a bear is to have a weekly close below the 200-day moving average or the 40-week moving average on a weekly chart. So news, no significant news today, but Powell does speak again tomorrow. There were some other Fed speakers out. I didn't see any headlines coming back from them, but we will be keeping an eye on what time Jay Powell talks tomorrow. So coming into today, I was watching again. S&P 500 versus 200-day moving average resistance overhead and 50 moving average support below. You can see yesterday that this was the black line, the 200, and we basically spent the entire day Monday trapped between the 200 above where we were rejected and the 50 below where we found support. Today, breaking above the 200-day moving average in the morning, so definitely a positive sign there. I mentioned the gap up about 1/3% and then trending sideways to up all day. One thing I want to note, and this is kind of this is why banks have been acting better, but the 10-year note, which is 0TNX here, making new highs. You can see this big move since the Fed raised rates last week, and the 30-year 0TYX also making new highs. This is, if you've got bonds in your portfolio, I know you want to be diversified, but TLT is down almost 13% year to date. That's the long term. The TLT is the it says 20-year, but it really tracks the 30-year bond, and that's a big drag on your portfolio, especially if you're in a 60-40, and the 40% was in all bonds. A diversified bond portfolio is still down about 6 or 7% on the year, which is just about in line with what the S&P is down now. So bonds certainly not helping. That's why we're fond of saying we don't want to be diversified into something that's not working. It's like buying rotten vegetables at the market just to say that you've got a balanced diet. Stay away from things that are trending down. So strong sectors today, definitely tech dominated. The QQQ, I already showed that. Banks had a good day with rates rising, cloud stocks good, security stocks good, bonds lagged. Basically everything that was up yesterday, bonds, gold and silver, oils, fertilizer, defense names, those were up today. Sorry, they were up yesterday and they lagged today. Portfolio standpoint, we added to our bros position. Let me bring this up. Added to our bros position as it poked its head above 60. There's a big seller sitting at 62. We're about break even on that position right now. We also added to SSO. As we went above the 200-day moving average and then used the stochastic on a 5-minute on a pullback to get a favorable entry point for that. And that favorable entry point coincided with us getting out of SARK. This is really just a play. It was a play on the ARK funds, which had gone up 20+% in 4 days, just a reversion to the mean. But the market being so strong, we got stopped out with a 4% loss on SARK when it broke back below the lows of the 2 prior days. No reason waiting for a reversion to the mean. When you hit your stop, you just obey your stop. So bottom line, bulls continue to run. S&P 500 above the 200-day, NASDAQ 100 above the 50-day. If we continue to build on those gains, the market is going to be just fine. So here's the S&P 500. Let's go to the rest of the big 5 indexes. NASDAQ 100. You can see 2 days of a pause into the declining 50-day moving average, breaking back above it today. Just what you want to see. How about the Dow Jones Industrial Average? 3 closes now above the 50. Overhead is the 200-day moving average. Midcaps MDY. Second straight day where we tried to poke above the 200-day moving average but couldn't quite make it, closing just below it. But almost a week now above the 50-day moving average, which is still declining, and the 21 should come up through the 50 there. IWM, long way away from the 200-day moving average, but now solidly 4 closes above its 50-day moving average, and the 21-day going to cross up through the 50. Something I want to point out here on the S&P 500, everybody talks about the death cross, which is the 50-day moving average crossing down below the 200-day moving average, and what an ominous sign that's supposed to be. Well, that coincided with 1 day lagging the big turnaround and rally back above those key moving averages. We still have the 50 underneath and going lower, but in this case, the death cross, like Lazarus, I guess we could compare it to, had nothing to do with death and more to do with life coming back into the markets as we continue to trend higher. So key index levels right now for the first time. I can move today's close back above this 200-day moving average. And you can see, I mean, just a little over a week ago, this was all red as we were below so many different resistance levels. But money just flowing back into the U.S. stock market, taking us higher. And now the next thing we do is wait for the moving averages. If we continue to hold on to these gains, go sideways a little bit, have all the averages configured bullishly, which means the 21 above the 50 above the 200. And then continue to ride or take profits or set stop losses and lock in gains should things turn around and go south. We've got a plan either way. Let's talk about some individual stocks. Basically, let's take a quick run through the portfolio as we have it. We have long positions in SPLG. Why SPLG and not the SPY? A couple reasons. One, SPLG is just a 1/100% cheaper than SPY. But one thing I hate about SPY is once it declares its dividend, it holds those dividends for 5 weeks until it pays them out, which is just ridiculous. So most of them pay them out within a week. Most of the ETFs pay them out within a week. SPLG, plenty liquid enough to do what we need it to do to establish our position. So we've got a 15% position in there. We added to SSO, we've got a 10% position in this today. Now back to the individual names. Sedge bought this. Let's see, when did we enter this? Sedge was entered last week when it reclaimed, actually Friday, when it reclaimed, had a shakeout on the secondary offering, reclaimed the 21. So we've got some small gains in there. NVIDIA, I said it took a break today. It did. We bought this when it blasted back above on big volume, back above the 50-day moving average last week. CF, one that was red today, but we've got double-digit gains in this. Really just, this is exactly what you want to see after you have 3 days of above average gains, have a low volume, below average consolidation. Never good to see a stock down on a day when everything else is green, but after 3 straight strong up days from the low from like 80, the low was 86 on this to up over 100. So that's a pretty quick move with CF. CVX, we got into this yesterday. Just pulled back a little bit, consolidating. Nice tight ranges on this one if you want an oil stock that's not quite as volatile. CVX is your name, and then the other oil name that we've owned, which is a little more volatile. We've had it for a little while, actually in and out of it. Halliburton also consolidated on lower volume today. It's important that when you see your stocks consolidating, that the volume is lighter than when they were going higher. You definitely want to see favorable volume patterns along with your price patterns. Nucor steel stock also was down for most of the day today after making all-time highs. Did gain some of that back to close positive, although below yesterday's high, but this continues to act well and very similar to what you're seeing in the cyclicals, which is very strong over the last couple of days before, for example, the oils and fertilizers taking a little bit of a break today, but not with Nucor. Costco, our biggest position, consolidated yesterday, bounced off the 550 level today, ended up 0.70% on the day. You can see this was a very nicely formed cup and handle that it broke out of on above average volume. Tried to make higher highs, but pulled back on Monday on above average volume. Not much volume today on the bounce, but it is still nicely holding above that 550 area. And then our most volatile stock, Bros. We've got like a 58.60 entry in here, and then just above 60 for our secondary piece. Great fundamentals, very strong on Bros. They make money, high PE, but they are making money and growing rapidly. So those are the 1, 2, 3, 4, 5, 6, 7, 8 names that we hold in the portfolio, as well as the index position on the S&P 500. As we continue to make progress, we'll continue to add exposure at low risk entry points and let the market dictate how profitable we continue to be with those positions, or if it takes us out, we've got our stop set. So that's going to wrap it. As always, love to hear from you. You can email me, don@revereasset.com, or phone 855-REAL-WEALTH. So wrapping up Tuesday, March 22nd, this is Don Vandenbord with Just the Facts. Thanks for listening and have a great day.